Hey, everybody. Thanks for checking out the Aaron Advantage podcast. Today, once again, I have Erik Goodge with uVest Advisory Group. Erik, how are you doing today?
I'm doing great, Aaron. How are you?
I am doing pretty good. I'm really excited about this specific topic that you brought to my attention on what you wanted to discuss today.
Yeah, I imagined you would be.
Real estate as an investment option, something that I talk about quite frequently. So I'd like to kind of get it from your perspective and hear the questions you have and kind of have the discussion specifically on the different options that do exist.
Well, I think as a starting point, so when I talk about real estate or when I view real estate, I view it from an investment perspective totally, so from a financial perspective. So what does that mean? Well, real estate to me can take two major broad forms.
Okay.
You can have physical real estate. That's right up your alley. That's what you buy
What
and
I do
sell.
every day,
Yeah,
absolutely.
exactly right. Or you could have, I guess what we'll call exchange traded real estate. So things like people will call them REITs. And REITs is just an acronym. It stands for Real Estate Investment Trusts. Real estate investment trusts come in a lot of different flavors, but they essentially trade like mutual funds or like stocks would in your portfolio. And it's a way to hold real estate. And it's a little bit more liquid because if I want to sell a share of a REIT, I just sell it in the market, and that's that. Whereas, if somebody wants to sell physical real estate, they hire someone like yourself, and they go about it that way. But there's advantages and disadvantages from both aspects. So, just kind of, I'm trying to figure out where I want to go with this discussion. I guess I would start out. I talk to a lot of people who are really interested in real estate as an investment,
Right.
Physical real estate, like buying rental properties, that sort of thing, right? And they always have this idea in their head that there's this like duality. It's like, should you invest in stocks or should you invest in real estate? And to me, that doesn't make any sense because
They're not mutually exclusive at all. I can't talk today. Mutually exclusive.
Yeah, it doesn't make any sense. It's not as if you're trying to find the absolute best investment in the world and then go all in on that, because there's all kinds of problems with that. Your best investment might very quickly become a terrible investment, and then you're just stuck with a crappy investment.
Exactly.
So these people, occasionally I'll have conversations with them, and they're like, well, you are, you deal with stocks and in the stock market, and so you must be, sort of big fan of stocks versus real estate. But the truth of the matter is I think what we'll call alternative asset classes, different asset classes like real estate, precious metals, cryptocurrencies, I think those have a position in everybody's portfolio. Now, if you don't have the wealth already established to go out and buy a rental property, then there are other ways you can get exposure to real estate, like through real estate investment trusts,
Right.
These things that trade on the stock market. But if you've reached that point to where you can diversify beyond exchange traded products, beyond what we'll call the stock market, then I absolutely think you should pursue physical real estate, because that is a huge way to diversify your assets. It all comes down to asset correlations, and exchange traded real estate already has a very low correlation with the stock market as a whole.
Right.
But physical real estate is even better. There's almost no correlation with the stock market if you're holding physical real estate. So that's the perspective I take. I want to see people, we could get into the nitty gritty about why low asset correlation is important, but the truth of the matter is you don't need to know why it's important. You just need to know that the less correlated your investments are, the better off you're going to be.
I will be real honest. When you start talking about low asset correlation and stuff like that, when we have those discussions, whenever Kendra's involved in stuff like that, then I'm like, yes, let's nerd out. My wife glazes over. She's like, I got no clue what he's talking about. I have no understanding of this stuff whatsoever.
Yeah.
Just tell me if our money's growing and we're happy.
And it's hard too, because so many things are so highly correlated now. We live in a very, and this is fortunate, we live in a
interconnected world.
Yeah, we live in a very interconnected world. And when you look at buying something in the stock market or investing in real estate in the 70s versus nowadays, it is night and day. Today, you can open up an app on your phone and you can make an investment in the stock market in less than 2 minutes. In the 70s, you'd already have to have a pile of money, and then you'd have to call somebody on the phone, like absolute caveman. You'd have to
Who
call.
uses the only thing I use my phone for is for a video camera to record these podcasts.
You would have
is
to,
what it feels like.
Yeah, you'd have to pick it up off the wall and like hold or receive. Yeah, you'd have to do all these savage things, and then you'd have to pay the guy like $100 for the honor, filling out physical paperwork and all this crazy stuff. But where I was going with that is that since all these investments are so easy to pursue now, which is good because investing is good, it's the way we build wealth, they're all highly correlated now.
Right.
And that is hard. It is hard to weather a downturn or get any sort of what we'll call a risk-adjusted return, which means a good return for the amount of risk you're taking
right.
when all your assets are highly correlated.
Properly hedging and making sure that you've got good diversification to make sure that if there's one thing that happens in the market, it doesn't tank everything you own.
Every single thing. And, one thing I think back to is like in 2008, when there was like this, and it spilled over into 2009, the stock market meltdown, and that started in real estate, but there was a lot of stuff going on there.
Yeah,
but
a lot of people a lot of people are scared of that happening right now with the change in prices and things that we're seeing. They're like, we're gonna have another real estate crash, and it's completely different because the things that were happening in 2005, 6, 7 that led up to 2008, they were abusing like the financial institutions. You came in with a hope and a handshake, and you're walking out with a mortgage, and
whether you could have afforded it or not,
exactly.
And they didn't care because they sold it off to the next guy in the chain.
100%. Whereas today, when we see things, we're looking at true market economics right now where inventory is low, demand is high, interest rates are low. So the growth in prices is, kind of a recapture of some of the stuff we lost. So those accelerated growth in prices looks kind of scary if you don't really look at, okay, if we were on a normal trajectory, we're kind of in line with where we should have been anyways, but it's also much more regulated financing. It's true demand. It's not just, I'm buying or building a second house or third house or anything else, which was what was happening back then. So I don't think we're going to see that same kind of issue with real estate moving forward.
Yeah, and that and I think the banks have the big banks, the big large investment banks like Goldman Sachs, Morgan Stanley, Bear Stearns, RIP.
Learned their lesson or didn't.
Those guys, I think, have a much larger understanding of the amount of risk they were taking with the various synthetic collateralized debt obligations, that these bets that they were making. Anyway, where I was going with that was that when that happened, when all that stuff blew up, when the banks didn't understand how much risk they were really taking on with all these bets and how interlinked everything was, assets fell like crazy. And not just stocks, bonds fell, gold, all this stuff fell. And of course, real estate fell. And it was because it's like a fire sale. It's like if you have to raise cash, you have to sell anything that's worth anything. And that comes down to things even like gold. It didn't, in the long run, it didn't crash. But if you look at like the COVID market panic last year, everything crashed because people were all throwing their dollars trying to get a hold of some cash.
Flooding the market with supply. Right. Which we had in the past year and things, but luckily through a global pandemic, we had the ability for people to kind of have an opportunity to take out these PPP loans and other things in order to kind of offset.
They had to
that global calamity that you speak of.
Yeah. So that's the real value with real estate. So I kind of chuckle whenever I get these people, real estate enthusiasts. I consider myself sort of real estate enthusiast, although I haven't had the honor or opportunity yet to buy any physical. I do have plenty of exchange traded real estate, but it's not as if I I don't feel like the stock market has any advantage over real estate or vice versa or any of these other assets. I think they all play a role in a prudent investor's portfolio.
Couldn't agree with you more.
Yeah.
So I want to kind of dive into a little bit more on, it's on the cash flow with that side and everything else, because that's one thing as a real estate professional that I really try to make sure I'm diving into an investor's mind when they're thinking about investing in real estate.
Mm-hmm.
Typically what I tell people is you can invest for appreciation or cash flow. And you really need to have a strategy specifically separated out to one of those two, because if you try to aim for both, the likelihood that you're going to get is going to be a lot harder.
Yeah.
So if you're looking at cash flow, that's when I'm talking to people about picking up portfolio properties where they're buying homes, renting them out, holding on to them long term. And I let them know, hey, if you want that cash flow investment, it needs to be a more long-term investment.
Right.
Kind of like these REITs are. It's a longer-term investment because that's literally what you're doing. You're just buying these huge cash flow portfolios.
Right.
If you're going to do that, you need to do the same thing with your actual physical real estate as well.
Sure.
Hold on to it for a while. Get those renters in there and do those things. Harder to get appreciation on those. Not impossible, but harder to get appreciation on those because as you own it, you also have to maintain it.
Right.
So a lot of the rent that's coming in, as it comes in, it's real nice, it's great, but you're paying down a debt service.
Sure.
If you have any debt on the property, you're paying for all the maintenance and upkeep of the property. Sometimes there's repairs and things that have to happen after renters are in there. So if you're just hoping that, hey, as I own it, it's going to also go up in value, that's not necessarily going to be the case.
I don't remember the book I was reading. It was a tax book, but it was in regards to real estate. And the gentleman made the argument. He said, when it comes to flipping versus like buying a rental property, cash flow type of strategy, you can almost look at that as like a equity versus cash flow sort of thought experiment. So
Right.
on the one hand, flipping, that's an equity strategy because when you flip a property, you're pulling that you're getting whatever you make is the equity you had in the property.
Right.
If you can increase that equity through forced depreciation, like, adding a bedroom or something, I don't know. Great. That's awesome. But cash flow is way more important from a business standpoint than equity is. He said that lack of equity doesn't tank businesses. Lack of cash flow is what
100%.
tanks businesses. And I thought that was really interesting because I got to thinking about it. I was like, you can have a business with zero equity. That happens all the time.
With business with negative equity.
Negative equity, in fact. Yeah, that happens all the time as long as there's cash flow. But I have yet to see a business with a bunch of nice equity and zero cash flow that people are scrambling to buy, because that if it's not generating any cash flow, you're not being able to keep up with those expenses that come up. You can't keep the business running, and so a property essentially is just a business. That's all it is, right? So you need to have cash flow to cover those things for you to stay on the right side of the black.
Absolutely, and a lot of people, that's the hard thing for them when they get into the rental investment business. They don't think of it as a business, and they don't think of each individual house that they have as its own little business entity. Now, I'm not saying you have to set up a corporation or do any of these things for each house that you own, but you really do need to have each of them and say, all right, I'm running the books on this property as if it's a business. What are my advertising expenses to find a renter to get in there? What are my vacancy costs if I don't have somebody in there and I'm still holding the property? I still have bills I got to pay. What are my maintenance fees going to look like? Because you're going to have repairs. You might go a couple years without anything major, but guess what? 10 to 15 years, probably going to put a roof on it.
Right.
What happens when we have a storm? You got to have to pay your deductibles, all those things. So you said it so perfectly and illustrated it so well with, you got to think of each house as a business. And I think that's something that's missed by so many people.
Yeah. I guess that is one important distinction, between, real estate, exchange traded real estate. Well, I guess that's a term I just made up, by the way. I don't even think that's a real term. REITs and physical real estate is, when I buy a REIT, I don't think of it as a business. It's an investment because, there's I think a subtle distinction there. I'm not looking for renters. I'm not looking for, marketing or any of that stuff. I can sell it, I can keep it, and that's it. But with a property, it is very much a business, and individual properties are very much individual businesses. I agree. I don't think I've heard horror stories of people with like 40 different S corps for 40 different crappy houses. Yeah. And I don't think that maybe is necessary. I guess you'd have to talk to a lawyer about that, but it is very important when you're doing something like bookkeeping, that you're doing bookkeeping on your individual houses separately. Because I don't, I'm not, you probably know more about this than I do, but I would imagine that across your portfolio of houses, you're going to have varying expenses for things like how long does it take for me to find a new renter for this house versus, a portfolio or a house in this part of town or this neighborhood.
Right.
What are the marketing costs for these different properties? And if you're, I would think if you're buying physical real estate, you're doing it with the idea that you want to grow a portfolio and you want to improve the performance of that portfolio. There's no way to evaluate the performance of a portfolio if you just have everything thrown in together and,
right.
There's no way to know.
If you're not classifying the actual adjustments of the assets that you're looking at, you can't say, oh, my portfolio is doing this, because you have to understand each individual piece of the portfolio.
Yeah, if a client came to me and they say, hey Eric, how are my investments doing? I could say, hey, you got an 8% return last year, good job. But that's not really informative.
Okay, 8% average. Did anything underperform? Is there something that we should reallocate to go somewhere else?
Yeah, I mean, how did my real estate do in the portfolio? How did my bonds do in the portfolio? How did my stocks do? Whatever. And then even within that, how did specific different types of stocks or bonds do? So yeah, I do think it's important to classify your physical real estate as a business. In fact, you would probably do well to even incorporate, or maybe not incorporate, but get an LLC.
Mm-hmm. Absolutely. I recommend that to anybody who's thinking about investing in multiple homes. It's always a good idea to have that business entity set up to hold title to those real estate assets, because it's a smart way to do business. It's a better way to make sure that you are keeping the books and running your rental business as a business, as it should be.
And there's some interesting wrinkles that go along with that, because a lot of people don't know that when it's the business holding the title to that real estate, the bank, whoever owns your mortgage is going to want to know that. It's not as if it's not like your personal mortgage where it's just, hey, Eric and Becca Goodge, here's your mortgage at PennyMac or wherever the heck.
Right.
There's different stipulations that go along with that can make things a little complicated, lending a little bit more complicated.
Yeah, and that's another thing that people don't take into consideration is you're not getting a normal mortgage when you're buying investment property. You're not getting the 3% rates that you can get on a 30-year fixed home loan.
I'm so glad you brought this up, Aaron, because there is a way you can, and I so wish I knew about this. In fact, I wrote a blog article about this recently about my greatest financial regrets, and this was like number 1 on the list. I wish I knew about house hacking before I had a family.
Okay.
Are you familiar with this term, house hacking?
Depends. I've heard it, but I don't know that I know.
Yeah, it's like a pop culture thing, or not even a pop culture thing. It's it's one of those terms invented by the internet. But basically, it goes like this: you buy a house with a regular, FHA super awesome loan that's almost no down. You get the great rate, 30 years, whatever. You live in it for 2 years, and then you move out and you rent it out. And you don't have to do it that way.
Hopefully you're not doing that with the FHA, because that's actually against federal regulation.
Really? After 2 years?
Yeah. If you have an FHA loan, you actually stipulate that you will not rent out the property at all.
So my understanding is a little bit different, but that would be good to know. So, but it takes different flavors. So let's do this in a way that's not potentially illegal.
Okay, sounds good.
So you get the loan and you rent out part of the property while you're living there.
Right.
That's one flavor that it takes.
Which FHA does allow, especially if you're buying like a duplex or anything else like that.
So with a conventional mortgage, I don't think there's any stipulations, right, for moving out.
Not to my knowledge, specifically on those.
So, okay. So with FHA, you wouldn't want to do this, viewers. But because, there's a rule. But two years, I believe, is my understanding that if you stay within this property with 2 years, you can move. You can leave a conventional mortgage and rent that property out and keep a conventional mortgage.
I believe so, yes.
So that's huge. Why is that huge? Because you're not, you have 30 years, you have a lower interest rate, you don't have this investment interest rate. That's something I wish I knew about.
Right. The downside that still exists there is you're still going to have that debt load that you have to then report when you're trying to buy another property.
You will have debt, but it goes back to our conversation, about equity versus cash flow.
Right.
I'm willing to accept some leverage if I have the cash flow, if I have some safe cash flow. Now, I don't want to leverage the crap out of myself and, just be on a razor's edge or anything like that.
Be at the top of a house of cards where one falls and it all comes tumbling down.
Right. But I am willing to take a little bit of leverage if it means extra cash flow. And for somebody like me who didn't know about this,
right?
If I want to go out and buy a property now, I'm going to have to go get a mortgage suitable for an investor, which is probably going to be 5 or 6%, something like that.
Starting off, you're probably 6, maybe more.
Yeah. I mean, if I can
depending on the relationship you have with the bank, how much you have on deposit with them, different things like that. They're going to want to see a couple years worth of your business financials. It's a lot more involved.
Yeah. They're going to want to make sure that I know what the heck I'm doing, which I won't be able to convince them of because I've never invested in real estate.
Right.
So all these things. But if you would have house hacked, and I've stole this term, I didn't make that term up, it's internet invented. I think it's like a Bigger Pockets invention. Are you familiar with that crowd?
It sounds very much like a Bigger Pockets invention, yeah.
Yeah, so Brandon Turner and that crowd. If you do that, it's a way to get your foot in the door and build an investment portfolio without all of that mess.
Right.
I had a buddy I was in the Marine Corps with who, when he got out, he did this. He lives in Ohio, kind of in the Cleveland area, and there's, I guess, a bunch of duplexes in Cleveland. I don't know anything about their market, but there's just duplexes galore, and they're cheap. So what he did is he bought a duplex and just lived in one of the units.
Right.
Rented out the other unit with the mortgage, with the conventional mortgage.
Right.
Which was huge for him because he didn't pay. He essentially got his mortgage for free because the unit that he was renting out was covered enough to
pay the entire mortgage on the property
and expenses, and he had like $100 left over or something for cash flow. He just pretended it wasn't there. He just saved it. But so that was his first property. After he built that up enough, he got comfortable enough with that. He moved out of that unit, rented that unit out, did the same thing. And just rinse and repeat, did this over and over again. Now, this, I haven't been out of the Marine Corps for years and years, so he's only been doing this for about 10 years, I think, and he's got like 5 properties now.
Nice.
And looking at quitting his job and just doing this, buying property and renting it out.
Nothing wrong with that.
That is a little risky, but I mean, because, anything could wipe out your one, claim to your livelihood, but as long as you're diversifying your portfolio across asset classes, I think that's just hugely smart. I wish I knew about stuff like that before I got married and had kids.
It's always amazing the things that you wish you could go back and correct as you learn and get older.
Yeah. I certainly don't have any regrets about getting married and having kids, but it's just that is such a cool opportunity to me.
Yeah. And I wish more young people knew about those opportunities. I've got people that come to me all the time who, want to get started in the rental investments and do all these different things. And they don't even realize they could start by buying something, living in it, and having somebody else pay for it, and still allow themselves that opportunity to find other opportunities to invest or grow their money so that if they do want to start with these true commercial investments, then they've actually got the assets available to go and make that happen.
And the history.
So if you start off by doing those kind of things and getting that going, it makes it a little bit easier to just walk into that true commercial investment a little bit more, grow that portfolio, get a larger line of credit, be able to really grow that rental business a lot faster.
Yeah, I totally agree. That's not the other one, the only one. The other one, I think I read about this one recently. It has a nifty acronym. It's like BRRR or something like that. It's like buy, rehab, refinance and rent and refinance.
Yes.
So are you familiar with this?
I am familiar with this. So that's the process of basically going in and finding these properties that are in disrepair or just not great condition, and then basically go in, you buy it real cheap, you do a little bit of rehab, you refinance it out with the after rehab renovation, or you refinance it on the front end to get the cash to do the renovation.
Mm-hmm.
And then you have it done, ready to go, and then you rent it out. And it's a lot cheaper to do it that way. You're using somebody else's money to do the renovation, so you don't have to have all of the cash up front, and you can keep doing that and then paying down that debt. So that's a big thing that a lot of people do. It's getting harder in our market to try to find some of those things.
I bet.
It's getting harder in most markets, honestly, right now because of the lack of inventory and the shrinkage of inventory that we're seeing that's just driving those prices up. Doesn't make it impossible. It's just you got to do some real work to find those kind of deals to make those kind of things happen.
Yeah, it's almost like you're looking. You're. I mean, at that point, yeah, the way you described it is exactly the way I've heard about it. It's like these people come in and they buy these properties with almost no financing. They buy them like cash, and then they try to buy them for, I think they say like 75% of after repair value, because that way, if they can get 25%. Or 75% loan to value on the after repair value, that means when they refinance, they can effectively pull all their cash right back out.
Exactly.
Which is crazy cool to think about, because it's almost like you're putting cash down to buy this property and then pulling it right back out, and then I guess theoretically you just keep doing that over and over again, although you'll get leveraged pretty quick.
Exactly. A lot of times they're trying to do it so that they're growing their actual asset valuation beyond the initial cash down payment, so that they can pull out more cash than they put into it.
Yeah.
Because they have the ability to do it. Now here's where I got to step in and say a couple disclaimers about this kind of stuff, because these are the kind of people who are coming in and they're actually doing the work and making the renovations and are able to actually grow that equity faster, because unlike what you may see on HGTV and things like that, when you do these kind of repairs to a lot of properties, it's going to cost you a lot more than people think.
Sure.
And it may not give you the equity growth that a lot of people anticipate.
Right.
My biggest concern with the other side of real estate investing, which is like the flipping market and everything else, is people see these shows like Flip or Flop and they hear these costs of, oh, it's going to cost us, $17,000 to do this kitchen, or, oh, it's going to cost us $8,000 to do this bathroom.
Right.
And I hear those costs. I'm like, that's the cost of like materials to do this kind of stuff. Or that's the cost of, certain upgrades for some people, but they don't read the full disclaimers at the end of the shows where it's like, oh, by the way, we actually own these construction companies. So we're actually not paying anything other than wholesale prices on the materials. And then we're paying hourly wages to our contractors.
Yeah, that's a good point. I mean, unless you know what the heck you're doing, if you need to if you're gonna freaking, I don't know, what could you do? I guess the kitchen, or maybe add a bathroom or something crazy. I don't know. I certainly couldn't do that.
Right. But if you're gonna try to do this BRR kind of investment strategy of buy it, rehab it, refinance it, and then move on, you better have a good team.
Yep.
Or you better be doing some of the work yourself so that you can really multiply that investment of time and money to do those repairs to grow that equity faster.
Yeah, I would think if you were somebody interested in that strategy, I would think you would definitely, if you aren't already a construction, whiz of some sort, you at least know some sort of contractor.
You got a relationship of some sort, yeah.
Because I can imagine that you're right. You're what you're trying to do is you're trying to buy these properties when they're dirt cheap because they're distressed in some sort of way for some reason, and then pull at least what your investment was in cash all the way out, and you're left with the equity and the cash flow. So that can get complicated, especially in our market with there's nothing,
prices continue to rise.
Yeah.
I mean, I think I shared the other day with my networking group. You were there. There was an infographic of the United States.
Yeah.
And it showed basically every state as an individual market, which a state as an entire market is hard to classify at times because it's so hyper localized for real estate sales. But if you look at the United States as a whole, inventory shrunk from February of 2020 to February of 2021, 48.7% nationwide.
Yeah, and it's like 57 here, right?
57% down in the state of Indiana.
That's crazy.
And if your inventory shrinks and your interest rates and demand stay the same,
or drop.
You can see why prices have continued to rise. I hear from buyers all the time, well, everything's overpriced right now. And I'm like, I hate to tell you, it's really not. It's market priced right now. That's just what we're dealing with. But it's making it harder on these investors to try to go in and do anything.
Oh, sure.
It's minimizing margins if they're trying to flip. It's making it harder to get good cash flows if you don't have more money to put down or a larger line of credit because of the fact that even on these lower end properties, sometimes the prices have come up commensurate to what the rest of the market is doing, and it's making it difficult.
Yeah, that's supply and demand, right? I think I saw recently the Biden administration unveiled, I think they call it like the Build Back Better plan, and that involves a lot of things. But one of those things was building something like 200 million units or something, not 200 million units, but a lot of new units, 2 million units or something like that of new housing, affordable housing. And I was sort of thinking about what shape that might take. And in my mind, I would probably work with lenders or something like that to make construction or make purchasing these properties more easily available. I don't know. I'm not sure how that would look, but it is getting pretty tight out there.
Yeah, I'm trying to remember what the actual statistic is, but a lot of the reason we have the inventory shortage that we do is we've had a shortage of new housing starts for several years just to keep up with population growth.
Yeah.
So that's made it harder and harder and harder to continue to have all of these things happen where we need more houses so that people are in a position where they can move up if they need a new house that doesn't exist, or if it's a new person who's entering the market, there's nothing for them to buy either. And the ability to build a affordable home for somebody to buy as their first home is getting harder and harder because the cost of materials and everything has gone up. So there's so many factors that are going into the fact that the inventory is just shrinking over and over and over again. That's making all of these aspects harder. So knowing that, there could be new, more affordable housing starts is so impactful and will make the rest of the market kind of open up and make it easier to start investing in real estate.
Yeah. I've always, I'm by no means an expert, but I've always felt like it seems like certain areas like the Midwest and maybe portions of the South have always been a little bit more investor friendly with real estate. And the reason I feel like is because our real estate prices, or I say ours because we're sort of in a region that's sort of like on the border of the South and the Midwest. Housing here is cheap. It's really, really cheap. And part of that is because people don't make a killing here, but there's also people aren't clamoring to move to Evansville, Indiana usually.
Right. We're really well insulated against like the huge upswings and downswings in the market as well, which is another thing that's very investor friendly if you're looking at cash flow and stuff like that.
That's the flip side, yeah.
Yeah, so that's helpful in a lot of ways for people to look at it and say, first off, rents, typically they're staying the same or going up. There's not a whole lot of opportunity for that kind of stuff that is going to be dropping like crazy or anything else like that, which is nice to see. The other thing is because we don't have those crazy swings in valuations, investors can come in and do some of that flipping or that equity building real quick because they have the ability to project a lot more clearly what's going to happen. So that's always been something that's nice about the Midwest area and the South in ways, because having that more stable valuation of real estate that you can really pay attention to and know what's going to happen is one of those things you have to have when you're planning your rental business or your flipping business.
Yeah, definitely true. We started off talking about flipping versus cash flow or versus renting. And I would think, flipping might be more popular. I don't know this to be true, but I would think that flipping would be more popular in places like, I don't know, like Miami or Las Vegas or California or something like that, where there's just, this crazy price appreciation.
You don't see any of those flipping shows in Evansville. I mean, there's one in Indianapolis called Good Bones, but they're not flipping so much as they're going in and just like gutting out these houses that have good bones, like nice structural, integrity and things that they can go in and make it a nice new home for somebody. The places you're seeing this flipping and everything else going on, like you said, it's California, it's Canada, where there's a whole bunch of stuff like with the Property Brothers, where they've got crazy appreciation going on. You're absolutely correct on that.
Yeah. So that I guess all those things kind of factor in to make this market kind of an attractive market for rental property investors. I've even seen these services these startup services are kind of new. In my opinion, they're kind of new, where it's kind of like a internet dating service, but for rental property investors. And
I've not seen this yet.
It's like for out of town people, like people in these higher price markets who want to invest. So what they do is they say, "Hey, I want to invest in St. Louis, Missouri, or something. I don't know," and they say, "Okay, tell us your parameters. What do you want? What kind of property do you want to invest in? What kind of valuations are you happy with? What kind of cash flow are you happy with? That sort of thing." And then they say, "This is what I'm happy with. I want $300 of cash flow per door. I want this kind of property and whatever. So this is the price point." So they say, "Okay, here's this service," and then they kind of like match them, and then they take a nice commission, obviously, for making the match there. But I just thought that was so clever, but also so insane that these people are buying up these properties.
It's one of those things that the super wealthy people from other countries, other states, and all this stuff, like they're trying, and it just baffles me at times. They can invest here. Mm-hmm. They've got all this cash. They got to get out of other investments, or they got to do other things, and they can buy stuff here at relatively cheap prices compared to a lot of other places for great cash flow. Mm-hmm. And, they may be like, "Oh, hey, I'm only going to earn 5% return on the money that I'm putting into it." But where else can you put large sums of money right now and get a 5% return consistently?
Well, it's certainly not the bond market.
Exactly. Yeah. So that is something that a lot of people will look at, and they'll come here and they'll be able to do that. And it's interesting to see as a real estate agent watching those kind of things happen. Over the past few years, I've heard more and more of that, where larger like investment groups and firms will buy up like apartment complexes and things of that nature.
We started off talking about a little bit about we touched on the last economic recession, mm-hmm. and a lot of that, this wasn't the primary cause, but it was a cause. A lot of that was fueled by overseas money actually flooding into our real estate markets, which I always thought was interesting, because that's sort of an unspoken cause. There was a lot of other abuse going on, but that was sort of one of the I guess one of the sources that inflated the bubble a little bit.
Right. Absolutely. Man, I really think I could talk about this all day, every day.
Yeah, well, I don't have all day or every day, but maybe we could do this again. There's so many interesting facets of real estate as a asset class to me. It's a great tool for investors who have reached a level where they're looking for an additional additional diversification. Once you've built your wealth to, I think, a certain point, it gets more and more important to start trading off risk for, just stability.
Yeah, absolutely.
Or return for stability, actually.
The number escapes me right now, but statistically, more millionaires are made by investing in real estate than almost any other class.
Well, I believe that. I mean, just look at what other investment can you go in and leverage yourself to the hilt and get a pretty stable, what most people consider safe return. You can't do that in the stock market. You can certainly leverage yourself a little bit, but it's a lot more difficult, and there's a lot more regulations, and it's not like what it is with real estate. So I definitely believe that would make sense.
100%. So, well, Eric, I really appreciate you coming in and talking about this today.
It's my pleasure.
I think it's a little more eye-opening for people to realize that real estate investing is not just necessarily buying a rental property or flipping a house. There are asset classes that you can invest in and do additional things, and it's definitely a very interesting and intriguing topic to discuss.
Yeah, absolutely, Aaron. And thank you very much for having me. This is our third installment of Aaron and Eric. Right?
It is. This is third installment of Aaron and Eric.
Yeah. So I'll have to be thinking about what we'll do next time. But this has been great. Thanks so much for having me.
No problem. Anytime.
All right.
Hey, this is Aaron Luttrull. Thank you so much for checking out the Aaron Advantage podcast. If you would like to be a guest, please feel free to reach out to me anytime. We're always looking for other people to interview.